morning, everybody, and welcome to FOMC Wednesday. We are a couple hours, 8 hours away from some of the most adrenaline rushing trading that you will ever experience, going from 2:30 until the closing bell. Go over yesterday. Not much of a gap down, only a couple of points, and like I had shared over there in the chat room early in the morning, last Tuesday, Taco Tuesday, was our minus 1% day after waiting a month to actually see one. Planned on seeing minus 41.55, minus 41.36, and, there again, started looking at everything with all the alerts coming out there of what we were expecting to see. And it was pretty cool because we had a 74-point range. Okay, that is your largest range that we have had since we hit 3909, way back on March 24th. The low where this wave started, that took us up to that 41.8692 on Monday. And again, really, really cool. You're talking here, this was on March 22. I'll cover that in a bit. But yeah, 4140 puts. You got them at $4 as much as you want for the first 30 minutes of the day. $45 2 hours later. 10 bagger all day long. Come back, and as we got into that little bit of oversold, how we were talking about, boom, 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 hit our 1, 2, 3 targets, broke down below it. Grenby, 1,600% on his trade, $95 to $16. Then we started getting into the time where we're looking for a bounce, and our bounce we were looking for was 41.36. Obviously, we didn't get to it, but 41.40 calls paid off in 100%. Then later on, right around the last hour of the day, you had that little bit of a bounce, 41.35 calls. Took about 20 minutes. You got a little bit more than 100% on those. So, again, a lot of fun. More importantly, over on the spreads, you got to have that 41.65, 40.60 bearish call spread, full credit, 100%. And then as we hit that low down there, and I threw out there for risk takers over in the room when we were down in the 4090s, I'm below 4100, that 4105, 4100, and the reason why I was throwing that alert out, and again, full credit, end of the day. On Monday, we threw out that 4140, 4135 bearish call spread on the SPX for today, for Wednesday. $4 credit, $1 at risk. Dropped down to $1 yesterday. Why in the hell not take 300% and not even go into the FOMC meeting with any kind of risk involved? 300% on the trade a day prior to when the event's going to take place. So what I want to do is re-walk you back through the email from the weekend. AMD reported earnings. AMD took a complete shit. Not good. No bueno. No bueno, no bueno, no bueno. So we get the FOMC decision and Jay Powell's statement. 2 o'clock is the decision. Nobody cares about it. 2:30 is the statement. Not really that important. But the question and answer is when you really start to get your shake and bake, and I'll show you. Now, tomorrow morning before the open, you get the ECB rate decision, and they are hawkish as hell. Not that they make too much of an impact, but you need to know that you do have the DAX and the FTSE very, very, very close to their all-time highs, as well as the CAC 40, which just made new all-time highs back last month while they were rioting in Paris and beating up old ladies. Apple earnings are after the close tomorrow, and then we get the jobs report on Friday, and then we get Fed's Bullard, and all the Fed heads start talking. So bring you down again to where we are, and more importantly, I want to really, really, really emphasize we do have gaps to the upside, which could possibly be spoken up towards as we go into this meeting today, or off the question and answer today. They could say something because of the banks that could cause a pop up into that 4203, 4228. I really don't see how they can stretch us to 4284, 4266, but it's there. So it's there for you to know about. 4156, 4175 from last week on Friday. Very, very obviously, we filled that yesterday on our dip down. And again, bring you into the wider point of view that we have 7 consecutive green weeks on the SPX. Yes, we were down -4 points 2 weeks back, but let's just call a spade, and it is what it is. It is a 7-week run. So again, 7 weeks coming off that 3808. Very, very, very much looks as if we have completed our wave 5 of this wave off of that. No new highs, taking out the February highs from earlier this year. So it's again starting to look as if the full moon is lining up, which is on Friday, where we are about to place a top here in the next couple of days and start to retrace and fill some of those gaps to the downside to energize our wider time frames for as we go into June, when there actually is a pause in rate hikes. So skipping all of this part here, which you can go over again with the consecutive weeks and blah, 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 and how this is doing and how everything is still all inside of QQQ. QQQ has all of the meat of the downside for the SPX. So here are your FOMC meetings, like I've posted out from going back to January. You can see where your meetings take place and the eventual move that takes place afterwards. So again, not being very aggressive about this, but I want to just zoom in and bring you into understanding this. As you can see here, you do absolutely nothing until 2 o'clock. Nothing. And then after 2 o'clock into 2:30, you start to get a translation of what the first couple of written statements are. And then Jay Powell starts to talk. And then the question and answer kicks in. And somebody today will once again ask, these bank failures, when are you going to pause? When are you going to cut rates? And it will be as if it was back in March, where he said, absolutely not. We are not considering cutting rates until inflation is under control. Blah, 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 blah. And then you get your move to the downside. March 22, we're down 1.65%. It was a 100-point range on the SPX from 240 to the close, hour and 20 minutes. February, again, same thing I'm showing you here. We had gapped down and stayed below the gap all day on February until we got into the meeting, until we got into the question and answers, and then we had that major shove to the upside into that 4100 area that we had been having trouble with from all the way back in September. The next morning, on February 2, we gapped up above it, went up to that 41.95, and everybody knows what happened after 41.95 over there in February. We dropped 9% into March 13th, just having missed the full moon by about a week. So again, January, well, it is way too far back going to January 2022. 3.61% 2 days after it. March, we ran 9% for 9 sessions. May dropped, June dropped, July 8%, 8 sessions. 14 sessions after it, we had the August high. This was July of last year. September, November, December, all of them declines, 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 declines. So again, your trend into 2 o'clock going all the way back to January is just flat. 2:30 comes around, you start to get some kind of aggression. This is back in March when we were having our big rally after we had had our very initial drop from the all-time highs into Russia's invasion into Ukraine, and we were inside of the bounce here already. So already have a little bit of a move with a gap up, and then bang, after the FOMC meeting, a little bit of a dip, oversold, close the gap on the SPX, and right on up. May 4th, flat all day long until you get that meeting, until you get the question and answer, and then your move. Same thing here in June, same thing here in July, same thing here in September, which was very aggressively bearish. Right when the statement came out, your dip, your bounce back up, looking like we were going to go up, and then your body slammed to the downside, down 1.71% on the day. November, same thing, flat, 2 o'clock meeting, statement comes out, questions and answers, bang. Same thing here in December, again, all the way across, doing absolutely nothing. 2 o'clock comes out, they have the statement, ba-boom. And December was the smallest range of 88 points. 88 points. So I want you to remember here as you go into today, 88 points has been the smallest range on an FOMC day that we have had going well back past over a year. We are in 7 consecutive green weeks. We went into this week with the SPX and NDX overbought on their daily and on their weeklies, and having had that 20 session run without a minus 1% dip, we got another one yesterday, and that is now 2 in the course of 25, 26 trading sessions. 20, 1, 2, 3, 4, 5, 25 trading sessions. We have dipped two times down to minus 1%. Today, minus 1% sitting at 40.80. So as the day progresses, we will undoubtedly be looking at that strike at 40.80 and see what the pricing looks like on those. Coming back again to where we were. So again, having looked at how this wave has transpired over on the SPX, it appears, as we talked about that 41.74 and 41.82 on Friday, having accomplished it over there on Monday, and then seeing the reaction that took place yesterday, which is being blamed on the banks and debt defaults of the United States. Charts are charts, and charts are always there. And when moves happen, it's because charts are ready for it to happen. You remember back here last week, we were talking about we are aggressively, extremely oversold. This is not a place to be short. We are oversold, oversold, oversold. And we got this face fuck shove, dry fisted, straight up off 40.49 up there to 41.86. Charts are charts. So even though I can't get the entire wave looking at it from this point of view, but I will zoom it out and try and waste as little amount of your time as I possibly can. Here is our move off of 38.08, and no matter how I look at this and structure it and try and count it, this still continues to look as if it is the exact correct chart and wave pattern, wave count for what we're looking at. And right up here, as we can clearly see, a move from here with this looking as if it was a one move down, another move to the upside, possibly to around that 41.36 magical level. A move down below 40.55 would start to agree that we are going to be able to see our gaps get filled down here in these lower levels, which we have not seen since March. These gaps right here, April 27th, March 30th, March 29th, and although we do have many, many more that are down below 38.08, I am not expecting us to see anything lower than around this 39.08 level. Possibly getting down to around 38.50 where the bear market line is, but I do not plan on it. I'm not expecting it, but I do know that it's there. So we do have space to the upside, but from every way that this looks, on every different angle that's out there, there is a very strong resemblance and a lot of evidence to support. After Jay Powell speaks today, we should be looking for a move to the downside and looking for that low from last week, and very possibly beginning the rejuvenation of the VIX and bringing it back up into the 20s. The QQQ down below 317, filling these gaps that are going down here to 309. Many more gaps to be filled well below that, but that's just what we're looking at for right now. And the full moon would line up right with that. Everything starts to look fantastic. So I will see you guys extremely early in the chat room, as you will all be here. Again, yesterday, it doesn't take that many. $400, $4,500, $800, $9,000. Last month, March 22, with Jerome Powell saying what he was, $5, $500, $5,800. End of the day, full credit on those SPX 4,000 puts. So be very, very aware of this. Be very, very prepared for this. And more importantly, smile. We're making fucking money.